Welcome to vacationlord.com, your source for tools and tips for managing vacation rentals. In this video, we walk through how to file your vacation property tax return using a status called material participation. Under the material participation status, you are conducting your rental activity as a primary occupation. You are acting in a business-like manner. Do not file this status unless you can really show that you are conducting your rentals as a business. We will discuss the details of this as we go along. And please consult a CPA if you have any question as to whether or not you believe this applies to you. There are two main benefits when you file your property under material participation status. First, if you have losses on your rental property, they will not be limited in their deductibility. You can deduct them 100% against your other income. The second benefit is if you are in fact making a profit on your rental activity, you have the opportunity to use the qualified business income tax deduction. Under the qualified business income deduction, you can exclude 20% of your rental income from your taxable income. When you use this filing status, note that the important concept is the activity and not whether you actually have a company, an LLC, or partnership formed for the activity. And finally, there's one final test that you should know about is which form to use when filing. If the main activity of your rental is actually renting property, then you can still use Schedule E, which you would attach to your own personal tax return. If you are in fact much more business-like, you have other services added to the rental. For example, you're conducting your business as a bed and breakfast. The IRS wants you to use Schedule C instead of Schedule E. In this video, we assume you are not doing this, so we're going to use Schedule E. So let's get started. In this walkthrough, we are going to be using H&R Block tax software, specifically the deluxe version. While this version does not target real estate investors specifically, it is perfectly adequate for filing your tax return. So let's get started. The first thing you're going to do is go to the Rentals and Royalties section. Hit Take Me to Rentals and Royalties. Now, if you were entering a new property from the start, you would say Add Activity. However, for ease of explanation, we're just going to review an entry that I've already made ahead of time to make the discussion easier. So the first thing you need to do is enter the type, and you'll want to enter type 3, vacation short-term rental, as well as the address of the property. And again, for our purposes, this is an introductory video, so we're going to assume you owned it throughout the year and that you own it 100%. There are many special situations here that we're not going to get into in this video. If you have any questions about these, please let us know. We'll be more than happy to help you. And we expect to cover these special situations in future videos. Now, the very first thing is, because you're running this as a business, you are not allowed to have any personal use, so you must answer no here. The next thing is to tabulate days you rented the property, days you could not rent the property, as well as the number of days you owned the property. And again, for the purposes of this video, we assume that you owned it throughout the entire year, so you'd enter 365 here. Now, to make this tax filing easier, we suggest that you pre-summarize your income and expenses. Now, we provided an article and a spreadsheet in the links below that will help you do just that. So we suggest you look at that article and spreadsheet, and before you actually go to fill out your tax return, tabulate all the financials in that spreadsheet. It'll make it much easier for you. Now let's talk about income. From the IRS point of view, income comes from two places. First is income that is documented on a 1099 form called an MISC, and everything else. So if you did enough business with a third party such that they sent you a 1099, you would enter it here. Now, I want to mention something that's a key point here. This third party may take payments on your behalf, and if they take payments on your behalf, then they would fill out this form. They would fill out a 1099 to document your income. However, you must still be managing the rentals, acquiring the customers, talking to the customers. If a third party is doing that on your behalf, then you cannot file under a business status. You must go back to the active participation. So in this particular 1099, we're assuming that this was some marketplace site that simply collected payments on your behalf. And you would enter the name, the address, the federal ID number, as well as the amount of rent collected. Now, the other place where you get income is everything that's not on a 1099. So here you would sum up all your income for wherever you got it. It could be personal check. It could be homeaway.com. It could be your own personal marketing site, whatever. Tabulate that all here and enter a single amount in this last box. Now, depreciation is a topic in and of itself that's worthy of discussion. But the very first piece of property you need to depreciate is the home itself. And here we'll go through how to do that. You would click on Add Property, but for here we're just going to talk about one that we've already entered. So here we're talking it's the main property, the date and service, and you want to specify residential real estate. What that does is when you specify the property type, that in a sense loads the depreciation schedule. And in this case, residential real estate has a 28-year depreciation schedule. And of course, we're assuming you rented the property 100%. Now, in order to determine the amount to depreciate, we need to determine what the value of the structure is that are on the land. And the way that's done is you subtract what you paid for the property from, or subtract the land value from the what you paid for the property. So you'd enter the amount you paid for the property and the estimated value of the land. Now, a good rule of thumb here is land is approximately 20 to 25% of the value of the property. This may vary in your local area, so you may want to consider it for your local area. And here we go. Here's our depreciation amount, straight line depreciation with 27 years left to go. Next up, if you use a vehicle to manage your property, you can get a deduction for that. Now, the most common case, which is the one we'll discuss here, is that you are using your personal car or truck or whatever vehicle you have. It very well could be that maybe you're using it less than 10% of the time. So if that's the case, which we think is typical, you will want to use the standard mileage deduction. And we'll walk through that right now. You enter the description, date placed in service, which is when you first use it for the rental activity, and approximately the number of months where you did at least one trip for your business? Did you own or lease? Now, you want to be sure to check this first box if you just started using it. When you first entering the first time you enter the car, you'll say personal vehicle started using for business in 2019. You'll want to check that. That's if you are in fact using your personal vehicle. Do you have personal mileage records for this vehicle? If you are using your personal vehicle for rental business, we suggest that you do keep records and specify yes. Now, these are 3 mileages that are here to fill out the form. The important one is miles driven for business. That's the one you want to keep track of, and as well as everything else. So you'll want to know these other numbers, but the real important number for your deduction is this particular one, miles driven for business. So again, we're going to use the standard mileage deduction. That's relatively simple. It's a straight 58 cents per mile. Now, out-of-pocket expenses, let's review this a little bit. Interest on car loans and personal property taxes, they may or may not apply to you, but these 2 expenses would be covered in the standard mileage deduction. So, however, garage rent and tolls for business are not. So if you do have these expenses, be sure to enter them here because they will be added on top of your standard mileage deduction. And as far as this last set of information, we recommend that you click the first one, vehicle available for personal use during off-duty hours, because you are using your personal car. And also, we do suggest that you have written evidence supporting your deduction. And there you go, there's your deduction. Now, here's your summarized rental expenses that you need to enter here. So again, I would refer you to the article and spreadsheet that will essentially tabulate all this for you in these categories ahead of time. It'll save you a lot of time if you do that. But I do want to mention a couple of things here. Now, it very well could be that you pay commissions because even though you're managing it as a business, it's entirely appropriate for you to pay commissions to others who will help you obtain rentals. Where you might want to watch out for is management fees. So a management fee is typically fees that you pay third parties to actually manage the property, perhaps managing the maintenance of the property or managing the rentals. If that's the case, then again, you're not going to be you don't want to file under this particular tax status because that would mean that you actually are not running it as a business. So you want to make sure, in this case, I have management fees here as 0 because I didn't pay anybody else to manage it, so that's appropriate for this filing status. Now, all these other ones are fairly self-explanatory. Advertising, cleaning and maintenance, the insurance for the property itself, the real estate taxes, repairs, supplies, utilities. The one that may need a little bit of explanation is taxes. Now, what this refers to is use or sales taxes that you pay on rentals that you had to charge yourself, that a third party did not charge them on your behalf. So, for example, if you're renting property in Florida and someone writes you a personal check to rent your property, you are still required by the state of Florida to submit sales tax for that rental because all rentals in Florida, no matter how you obtain them, the taxes are required to be collected. So you enter that here. Okay, let's move on. Now here's an entry for mortgage interest. And this would only apply if you have a mortgage on your property. Now, the key thing to understand here is that when you apply for a mortgage, the mortgage company at the end of the year will send you a Form 1098, which specifies the mortgage interest. And that Form 1098, that number must match, this number must match what's on that form. However, that may not be all the interest that you paid. It's entirely possible that you paid interest on your closing cost in your closing documents. If that's the case, you want to make sure you specify any mortgage interest that was in your closing documents in this particular section here. Now, there are other rental expenses that may not fit the categories that we just talked about. Here I've created one called association fees. It could be that you have association fees for your property. It doesn't really fit into any other bucket, so we just put it here. And here's a summary of your expenses. Again, because we assumed 100% ownership, you rented it 100%, so that means your deduction would be the entire amount entered for all the expenses. Now let's talk about your rental loss. Now, it could be the case that you don't have any rental losses. You might actually be making money. But let's walk through this anyway. Now here we're asking a couple of questions, and what these questions are really getting at, they want to determine whether or not you're running out of the business as a business or not. Now, they ask about 7 days or less. It very well could be that you're not. Let's say no. Do you qualify as a real estate professional? Well, we are saying yes here. And again, this is not common because we are in fact considering we're running our rentals as a business. That's the whole purpose of this video, is to show you how to file your tax status as running your rentals as a business. So you would say yes here. Now, material participation has a bunch of qualifications. You must meet one of these tests. I'm sure that if you're a full-time rental manager, one of these will click for you. 500 hours during the year. You have regular, continuous, and substantial activity in managing it. In other words, does it look like your job? If it looks like your job is to manage rentals day in and day out, then you qualify. But let's say you are managing short-term rentals, and that's 7 days or less. So again, they're going to ask you the same question: did you materially participate? Of course, it's the same criteria. So of course, we're going to say yes here. Now, if you are in fact running your rental at where you are losing money from an accounting point of view on your tax return, then you'll be sure to want to say have passive losses carry over. You'll be sure to want to check that because as you file returns, those losses will automatically be carried over in the software. Here we don't have any because we just entered it, so there are no carryovers for this demo. And that's all there is to it. That's everything that you need to enter your Schedule E for your rental property. Now again, I want to repeat, if you have any questions or comments or special situations that you want to talk about, by all means, please reach out to us. You can enter a comment in the section below, or you can reach out to us on our homepage.